Billions of dollars are currently surging into artificial intelligence companies, driving major stock indexes steadily higher as businesses invest heavily in new digital infrastructure. But step away from the trading desks, and you find a parallel reality defined by elevated inflation, high borrowing costs, and incredibly strained daily budgets. We are watching a basic rule of personal finance break down in real time. Taking home a larger paycheck no longer guarantees you feel wealthier if the cost of basic services and groceries rises faster than your income. Two immense opposing forces are now colliding. A massive technological expansion is occurring at the exact same moment millions of households are quietly fighting a persistent cost of living crisis. This split reality makes it incredibly difficult to read the actual health of the system. An explosive, soaring market can easily mask the severe financial pressure building just beneath the surface. Technology giants are spending hundreds of billions of dollars constructing vast physical networks of data centers and cloud computing hubs, betting heavily that new algorithms will overhaul major global industries. Running these models requires enormous computing power. That demand has pushed the manufacturing sector into overdrive, relying on highly specialized human labor to produce the advanced microchips needed to physically build the AI boom. Investors have rapidly pushed stock prices higher based on these expectations, yet history shows that technological leaps often outpace short-term revenue, raising the question of whether current valuations reflect actual realized value or simply optimism for future promises. Back on Main Street, a completely different economic reality is grinding forward. The cost of daily life has not retreated to normal levels, and everyday consumer prices remain stubbornly high. This chart shows the difference between income and purchasing power. A steady green line representing wage growth is overtaken by a steeply rising red line tracking essential goods. To survive, a rapidly depleting third bar shows households draining savings to bridge the widening gap. Consumer spending drives the overwhelming majority of American economic activity. If households exhaust their financial runway and pull back on buying, the revenue supporting millions of businesses will dry up. The extreme optimism surrounding corporate AI investments exists in direct opposition to the deteriorating finances of the everyday buyers required to keep the broader economy functioning. Managing these two conflicting realities falls almost entirely to the Federal Reserve, the sole entity tasked with keeping the American economy stable. Their primary mechanism for controlling growth is adjusting interest rates, but manipulating the cost of borrowing money is a blunt instrument. It affects the entire financial system simultaneously and cannot target a single struggling sector without impacting the rest of the market. By keeping rates high to suppress inflation, expensive loans restrict capital for tech companies, risking a crash in AI investments. Conversely, lowering rates fuels business expansion, but a cost of living meter violently overflows, as cheaper borrowing risks reigniting inflation and crushing consumers. Financial analysts and economists are entirely divided on which path policymakers will take, closely weighing every new economic report for an indication of the next move. The Fed is trapped in a remarkably hostile position. They must execute the near-impossible task of cooling off the rising costs of daily life without suffocating the capital needed for America's technological growth. The current market momentum is facing a strict reality check. We are transitioning out of a phase of speculative excitement, and investors are now demanding hard data and tangible business results. Over the immediate future, three distinct indicators will dictate the economy's direction. The first is the policy test, monitoring whether consumer prices cool enough to give the Federal Reserve the room it needs to safely maneuver interest rates. The second is the profit test. The billions poured into server racks and microchips must eventually generate real-world, measurable earnings for the corporations funding them. The third is the power test. The American workforce needs to feel secure enough to maintain the daily consumer spending that keeps the vast majority of the country's businesses operational. The United States commands massive structural advantages and a highly innovative technology sector. However, if inflation persists, corporate tech profits stall, and consumers exhaust their savings, the markets could face a severe downward correction. The ultimate victors of this decade will not necessarily be the companies drafting the biggest technological promises. The survivors will be the organizations that can convert those ideas into actual wealth while navigating a highly pressurized financial environment.